the challenge going forward is that once the debt ceiling is resolved, because now that cash drain from the treasury is pretty much done. They pretty much, they spent the last 6 plus, maybe 9 months offsetting the Federal Reserve, and now they can't do that anymore. And worse than that, if the debt ceiling is resolved and they're able to issue a lot more debt, their target long term is to get the Treasury cash account back up to half a trillion. So, $500 billion roughly that they want to increase. So they want to suck liquidity back out of the market, while the Federal Reserve is still sucking liquidity out of the market. And so we risk going from a sideways liquidity environment to a deeply negative liquidity environment unless one of these entities blinks and changes course.
The debt ceiling is the financial market's equivalent of the Night of the Living Dead, a zombified relic of some ill-conceived legislation from long ago that lies dormant until Congress has to start talking about it again, at which point it rises and stalks the earth until some brave posse of partisan stalwarts, hopefully, put it back in the ground with a continuing resolution or a temporary spending measure, or some other means of deferring the problem to another day. In this video, Lyn Alden airs her view on the debt ceiling, the possibility of a nominal default, and the implications of these on liquidity. According to Lyn, when push comes to shove, if the U.S. federal government is on the brink of nominal default due to being constrained by the debt ceiling from issuing new net treasuries to pay off prior maturing bond issuance and fund existing obligations, the president could potentially cite the 14th Amendment, direct the Treasury Secretary to ignore the debt ceiling and issue net new treasuries in excess of Congress' debt ceiling limit in order to service previously authorized spending obligations and national debt, and then let the U.S. Supreme Court work it out later when this decision is challenged. Let us now get into the video and listen to what Alden says about this. Don't forget to show us your support by hitting the like button, subscribing, and dropping your comments below.
So the issue is that if that were to be hit, you either risk potentially default on the treasuries, not because they can always print the money, but they have these, again, self-imposed kind of restrictions on how they're going to break down control of it, or they have to start missing some key payments like Social Security payments or military salaries, things like that, because most of the federal budget is not, we think of like the federal government, we think of all the different functions they do, but that's actually a tiny part of the pie chart of government expenditure. The vast majority of government expenditure falls into the buckets of Social Security, Medicare, and military, and military adjacent things like veterans benefits, Homeland Security, that kind of stuff. So that's where the vast majority of spending is. And so when you have that debt ceiling, you either start defaulting or you start having to cut spending. And we've been in this period since January where they technically ran into the debt ceiling limit, meaning they couldn't issue net new debt, but then they still had a number of levers that they could pull in order to not actually run into those more severe consequences. The biggest one that they can do is that the Treasury has a cash balance that they hold at the Fed. The Fed is, like their checking account. They hold their cash balance at the Fed, and so they always have some amount of working capital. Currently, they target to have around $500 billion. So they have this, like if you were to say lose your job, like lose your income sources, and you can't issue any more debt, what you'd have to do to maintain your expenses, you'd have to start drawing down on your savings. And so essentially, that's what they've been doing since January, and now we're getting to the point where they're almost out of their cash balance, and they've already used some of the other levers that they can pull. And so now they actually start to hit the crunch time for either it's going to be extended, or certain payments are going to be missed. Even the holders of these long duration treasuries are still kind of assuming that even if there's a technical default, they will be made whole some days or weeks later as that's reconciled.
Alden also commented that when the debt ceiling is reached, the U.S. Treasury still has some options. For one, they have the primary cash balance that they hold at the Fed, which consists of money that they already collected from issuing bonds but haven't spent yet. They can draw that cash balance down to zero before truly running out of money. They can also perform some intergovernment borrowing, basically shuffling the books around. Alden further throws more light on the implications of liquidity, as we would see shortly.
From a macro perspective, beyond whatever, last minute deal or technical default or whatever they do, for me, the question is, once they get it resolved, what is the next steps for liquidity? So to answer your other question, if you go back, ever since early 2022, the Federal Reserve has been doing quantitative tightening, where they're reducing their balance sheet, and then they're also separately raising rates. And so they're trying to tighten monetary conditions. if we look at the quantitative tightening, what that means is that they let some of their existing bonds mature, and then rather than reinvest those as they would, they just don't reinvest those, which means that as the Treasury needs to reissue them, some other buyer has to come in and buy them. And so the Federal Reserve is basically slowly destroying base money, and reducing their holdings of mortgage-backed securities and treasuries, which means those securities have to be absorbed by other participants in the market. It's very similar to if they were to sell them, with some minor technical differences because they don't realize like a loss or anything like that. They just let them mature. Um, and that's been a liquidity drain, and liquidity drains are very correlated with kind of negative asset pricing. It's not great for markets. QE is kind of like inflation for financial assets. Um, and but that's been somewhat offset over the past 6+ months by the Treasury. So, the market did very, very poorly, especially in the first half of 2022, and extending into kind of the autumn of 2022. The market did very poorly. That's when you had just the Federal Reserve is drawing down the liquidity. And while they continue doing that since then, the Treasury started offsetting them starting around autumn of 2022, especially. And so the Treasury, like I mentioned, has this cash balance, and theirs was above target. They had more cash than usual in their Treasury General account, and we could think of that as almost like a void. They previously issued more bonds than they spent, and so they pulled in capital. They pulled in capital from the banking system and elsewhere, and they're storing it in this void that's not really being used for anything. So it actually kind of pulls liquidity out of the market while they grow that cash balance.
Are you tired of the boring old stocks and bonds and would like to add some much-needed variety to your retirement savings account? Look no further than iTrust.capital, America's #1 self-directed digital IRA platform for individual investors. iTrust.capital allows you to enjoy the flexibility and tax benefits of individual retirement accounts (IRA) while investing in the exciting world of cryptocurrencies. With over 30 popular cryptocurrency offerings including Bitcoin, Ether, Dogecoin, Polkadot, Axie Infinity, Polygon, and Uniswap, you can invest in all your favorite cryptocurrencies and trade them 24 hours a day and 7 days a week from the comfort of your homes. You can also invest in physical gold and silver, while personally taking charge of your retirement plans and future with iTrust.capital. iTrust.capital is committed to providing a safe and secure platform for investors. The platform uses advanced security measures such as multi-factor authentication and cold storage to protect investors' assets and information. iTrust.capital is also regulated by the SEC and FINRA, ensuring investors are protected by the highest regulatory standards. Investing just got more exciting with iTrust.capital's new conditional transactions feature. This feature allows you to set conditional buy and sell orders so you never miss out on market rallies or get trapped during downtrends. Step into an exciting new world of opportunities with America's #1 crypto IRA platform by following the link in the description box below. It is safe and secure and gives you the much-needed variety for your traditional Roth, SEP, or simple IRA. Don't miss out on the chance to invest in the future of finance. Click the link below to get started.
Okay.
Now, when they start reducing that cash balance, they're starting to spend it back into the market. They're basically pulling it out of this like liquidity void and putting it back into circulating liquidity. And so as they draw down their cash balance, it's pro liquidity. And so for ever since autumn of 2022, they've been roughly offsetting the Federal Reserve's quantitative tightening. They've been putting liquidity into the market about as quickly as the Fed's been removing liquidity from the market. And so liquidity was going down for the first, say, 3 quarters of 2022. But ever since then, liquidity's been going sideways. And if you look at the reason that's relevant, and this sounds very jargony, but the reason it's relevant is because the dollar index peaked in autumn of 2022, right
Okay.
when liquidity indicators started going from down to sideways.
Yes.
The S&P 500 bottomed right at the same time. The Treasury market in that autumn period was getting very illiquid. You were starting to have like bad tailing auctions. The move index was like at like record highs. It was a really kind of messy treasury environment. And that's also when the UK gilt market broke. It just outright broke, and the Bank of England had to come in and do like emergency QE to save the UK pension system and prevent like this like spiral, this like liquidity spiral. And so that like transition to a flat liquidity environment was relevant for a broad swath of assets.
Tuesday's negotiation talks initially provided some hope a deal could be reached. That followed optimistic remarks from President Biden and House Speaker Kevin McCarthy the previous day. But McCarthy reportedly said in a closed-door meeting to Republican colleagues that we are nowhere near a deal yet, hours after saying in the Oval Office, I think at the end of the day, we can find common ground. The back and forth has left investors on edge in the countdown to the June 1 X date, which is when Treasury Secretary Janet Yellen said a default is likely to come. Our base case remains that the debt ceiling ultimately does get lifted/suspended, though the journey to that end could be at the 11th hour and drive significantly higher market instability than appreciated by the market currently, Darko Lekos, chief U.S. equity strategist at J.P. Morgan, wrote in a note Monday. We expect a temporary/comprehensive deal on the debt ceiling to negatively impact federal spending and for a likely contentious budget negotiation process later this year, Lekos added. On the economic front, S&P Global's flash U.S. Composite PMI, which captures activity in both the services and manufacturing sectors, came in at 54.5 in May, up from 53.4 in April and better than the 53.0 estimated by economists, marking a 13-month gain for the index. Separately, new single-family home sales rose 4.1% in April to an annualized pace of 683,000, down a revised rate of 656,000, according to a report from the Census Bureau. That's still 11.8% above the year-ago level and higher than the Bloomberg consensus expectations of 665,000 units for April. While negotiations and discussions are ongoing, uncertainty looms over the outcome, leaving investors on edge. As the countdown to the June 1st meeting continues, the potential impact on federal spending and market instability cannot be overlooked. The upcoming resolution of the debt ceiling remains uncertain, and the market awaits a solution. In the face of these challenges, how do you think this situation will unfold? Share your thoughts and perspectives in the comments below. Also remember to give us a big thumbs up, subscribe, and turn on notifications for future videos. Thanks for watching.